there is income in global shares. I mean, if you look at the average index, you go, oh, it's less than 2% yield at the moment. But if you actually don't focus on the index is dominated by some massive companies with quite low dividend yields, and indeed quite a few US companies don't pay any dividends at all. So that sort of means that the index is not necessarily indicative of all the individual stocks. And when you start to look at individual stocks in just developed markets, we found something like 700 stocks that pay more than a 4% cash yield, which is reasonably, that's about equivalent to the average cash yield of an Australian stock. Obviously we've got franking on top of that, but so there's about 700 stocks that are similar in size to S&P 200 stocks here in Australia with 7%, with greater than a 4% dividend yield. So there's actually quite a few opportunities. The other thing is that a lot of these stocks, particularly in Europe, pay a single annual dividend, so it's actually quite chunky. Well, first one's clearly diversification, and I'll put it two ways, is 6 stocks in Australia pay out more than half of the dividends of the whole market. So even though that's in an S&P 200, so you think, oh, it's 200 stocks, it's quite well diversified. Well, hold on, more than half the income comes from just 6 stocks, so it's actually very, very concentrated. When we build a global portfolio, we look at 6,000 stocks, but we invest in 200, so we actually got a very, very well diversified portfolio. And the other thing is that you are diversifying some currency risk, because you are, by putting money offshore, you've got a natural hedge if the Australian dollar falls. If the Australian dollar goes to 60 cents or what have you, the value of your overseas assets will go up. So, and we saw a huge advantage of that in the GFC. When Australian shares fell and Australian dollar fell, actually global shares didn't fall very much at all in Australian dollar terms. So it was a very good hedge. So great diversification.